mindlessly selling gold against a 10-week dollar rally, but have run into an unfactored drain of physical gold, which the paper market relies on to leverage these Fed, COMEX, LBMA-centric borrowed gold short sales. And of course, what we're really highlighting is the officially driven Fed-centric gold market interventions. And why so aggressive? Because the Fed feels threatened that a rise in the use of monetized physical gold is undermining the hegemonic dollar-based sanctions that they impose.
Gold Silver News recently posted to Twitter a breakdown in the dollar, which continues to dominate the gold market, could eventually push prices above $2,500 an ounce. Gold has outperformed most other major asset classes in the past 12 months as it continued to resist rising interest rates while maintaining its role as a safe bet against inflation. Meanwhile, Maguire highlights the Federal Reserve interventions in the gold market have grown aggressive. Gold prices gained on Monday, helped by a slight pullback in the dollar as investors awaited a series of key central bank policy meetings this week, with the U.S. Federal Reserve widely expected to hit pause on interest rate hikes. AndrewMaguire, an independent London metals trader and analyst, is globally recognized for his understanding the precious metals market. Maguire states that the use of physical gold in Russian energy trade is disrupting the Western paper gold market. Recently, Krishan Gopaul, a senior analyst at the World Gold Council, tweeted that IMF IFS data shows gold reserves at the Central Bank of Russia rose by 3 tons in August. This means that its gold reserves are back to where they were at the start of the year, 2,333 tons. Russia will take the BRICS presidency next year, so we can assume that the new BRICS currency has not gone away. Meanwhile, if Russia is to use the oil weapon against the West, then it must put the ruble onto a gold standard again as a matter of urgency. Now, we are presenting you the clips of AndrewMaguire insights from his recent video at Kinesis Money. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
The larger picture, physical gold is increasingly being employed as the perfect barter currency for the sanctioned Russian energy trade. And in fact, this barter trade seems to have slipped right off the radar until just 4 weeks ago. In fact, we drew attention to this last time. This trade has actually not ever ceased to function, all the way back to when Russia officially pegged a gold gram price to its oil trade back in March 2022, when this incursion originally and the sanction originally hit them. And of course, the reason they did that was because it circumvented sanctions and it became the target of an official gold market intervention, which has not ceased since. However, this trade has just become far more sophisticated and at the margin is now severely undermining the resulting Western paper price as it runs into a higher, physically deliverable Global South determined supply-demand price. This is severely disrupting this siloed, leveraged, ring-fenced Western gold market structure. It's not a real structure. Leverage works in 2 ways. And at the margin, again, this unfactored exit of physical out of the LBMA CME ring fence, it presents the short sellers, people who've sold gold they don't have, relying on squaring these fiat-backed foreign exchange bets inside the casino. And they rely on that. And this is a big problem. Oh, goodness, look, I can't wait to expand on this in a minute. But before I do, to answer your questions, let's wrap up the short-term stuff now and then really get into it. Now, this might not interest non-traders, so I'll keep it to a minimum, but I promise I will get to the cartel's demise. And it is important because we do have to look after everyone here. There are people who really do require to know what the price is doing on a shorter term basis and the actual structure. So bear with. So first, really stepping back to look at the gold and silver short to medium term perspective as related to an overbought, Fed-driven dollar index rally. Over the last 2 weeks, the dollar index has hard tested its 6-month March the 10th high. So that was the last time we hit the 105s in the dollar index. Now, the dollar index has ridden steadily from around 99.58 on the 14th of July to 105. I think it was 105.43. I think it was before topping out last Thursday, basically. Now, when benchmarking the dollar index 105 level to gold and silver, under the daily chart chatter that we see, the volatility, it's quite evident that physically driven safe haven gold and silver demand is steadily eating into this 100% paper-centric inverse dollar to gold and silver algo. Now, to put things into perspective, look at the levels where gold and silver were trading the last time the dollar index tagged the 105 March 10th highs. On that day, the gold had just commenced a large rally, with gold trading from $1,830. And so last week's over $90 higher low that was created at gold futures, that was 1922 or thereabouts. So from a gold perspective, that is actually trading at $9,000 higher per COMEX contract than when the dollar index traded it last at 105. Now, that's pretty painful if you've bet against gold since March. And this illustrates how this long dollar, short gold foreign exchange trade is bullishly losing traction.
According to Maguire, reduced official interventions is making gold more attractive to many central banks. A large majority, 59%, of the banks surveyed expect between 16 and 25% of reserves to be denominated in gold within the next 5 years. Only 8% believe that gold's role will diminish. Maguire mentions the growing demand for physical gold post-BRICS summit, tied to discussions of a structured 20-commodity currency basket. According to Gold Bullion, the BRICS countries will use their currencies or barter systems to settle their trade balances, which will decrease the reliance on the US dollar as a reserve currency. Heading into the weekend, December gold prices last traded at $1,944.90 an ounce, roughly unchanged from last Friday. Although gold is caught in a tight trading range, it is held firm against major headwinds as the 10-year bond yield pushed to a fresh 16-year higher at 4.5%. Let's get back to the interview.
Fast forward to now, and despite every failed effort to block foreign exchange gold from being recategorized as a first-year asset class at the start of 2023 trading, if we remember, we evidenced the Bank of International Settlements squaring all of their swaps and leases and just getting them down for over 500 tons to zero at the Fed's expense. We did an episode about this. It forced the global liquidity providers to back up their foreign exchange gold bets with physical gold, bullion. So net of how many short gold positions officials can now offset against the speculators corralled inside this casino, it now severely limits the downside traction within a defined but rapidly rising stair-step range. Now, since the 1st of January, official interventions have become very limited, and current dollar pricing for gold is viewed as a multi-jurisdictional central bank buying opportunity for the global south. We've highlighted how these purchases are bought in small enough volumes so as not to incur large premiums. Now, then this bullion is then de-dollarized by way of exchanging, bartering it for oil, gas, grain. While this trade is very attractive for energy traders on a limited basis, this gold for commodity trade will very soon be formalized into Glazier's gold-backed 20 commodity BRICS plus currency. Now, this trade has become far more sophisticated, and again, at the margin, is now severely undermining the Western paper gold price as it is arbitraged against an increasingly liquid, higher, physically deliverable, global south determined supply-demand price. I cannot stress enough how when leverage unwinds at the margin, the unfactored exit of physical from this LBMA CME ring fence presents the short sellers relying on squaring these positions, these short bets against gold inside the casino. It presents them an increasingly larger problem. The Fed's bets against gold are coming into the crosshairs. Now, notably, As we mentioned last time, this drain on physical gold stepped up in earnest after the BRICS summit moved over to Moscow just 3 weeks ago. This was also on the radar of last week's East Economic Forum, the EEF Vladivostok, attended by leaders and government representatives from the Asia-Pacific countries, the Global South, allying themselves to build out a pivot from the West to Asia. None of this gets reported, really. Non-dollar payment systems were front and center of these meetings. And much as Glasiev's BRICS currency basket is under discussion, it is the gold-backed 20 commodity currency option that would plug the gap and ultimately enable a more formalized currency basket to ultimately be established. A more realistic, truer, global, physically determined supply-demand price is just unavoidable. And given gold will ultimately at least partly back some of 80% of a multi-trillion-dollar energy market, an as yet unknown higher gold price is going to emerge. And while the BIS and all the central banks except the Fed are long physical gold, there will be little resistance to a Western gold price revaluation elsewhere. And the Fed is going to have very little choice but to also tap into its gold revaluation accounts to avert global central banks en masse demanding repatriation of their exceedingly underpriced US domiciled gold holdings. This is a deal that is not on the radar.
Central banks within these nations have been strategically stockpiling gold reserves, a clear indication of their intentions. The top buyers of gold in 2023 will be the central banks of the BRICS countries, according to the World Gold Council. According to Gold Bullion, the BRICS countries will use their currencies or barter systems to settle their trade balances, which will decrease the reliance on the US dollar as a reserve currency. How could these changes in gold market affect global financial stability in the near term? Share your thoughts in the comment section below. If you find this video informative, don't forget to show your support towards our channel by giving this video a thumbs up and subscribe to our channel, and turn on notifications to stay informed about our latest videos covering more exciting topics. Thank you for watching.